Well, welcome to the Market Mondays webinar. My name is Carl Rodder and I am with Danny Haythorne. We're both senior market analysts at Capital.com. Danny, happy Monday to you.
Happy Monday, Kyle. Happy Monday, everyone else. We are ready for another session.
Yeah, so jam-packed week. It's perhaps a slightly slower start for the folks who are enjoying a bank holiday in the UK, but nevertheless, a interesting enough week to begin with anyway, and certainly an interesting end to last week, which will obviously drive the price action to begin with. But we will just start with obviously the necessary risk disclaimers, which is first from my perspective, or at least the Australian ASIC perspective, is that any information that you hear here is of general nature only, and it does not take into consideration anybody's personal circumstances. So please consider your own personal circumstances before you trade CFDs because they are risky products. And Danny, you've got something to add to that as well.
Yeah, just the same, as we say, we offer higher risk products at Capital.com. These are leverage products, so there's a high degree of losing your capital. Just be aware when trading these, which are CFDs. And of course, for those of you in the UK as well, spread bets, they carry the same level of risk as well.
Certainly. Okay, so let's just go through very quickly what we'll be discussing at a high level, and we'll obviously pick apart other issues as well. But I think the week is going to be impactful, but maybe a little bit lean in to some extent when you compare it to previous weeks as far as event risk is concerned. But of course, today is going to be very much driven by the fallout of Jackson Hole, and we'll have a discussion about what was said there in a moment's time. That sort of runs a little bit into this inflation data that we'll get before the end of the week, which could kind of test the Fed's mettle potentially. And of course, too, we've got NVIDIA's results, which has turned into a bit of a macro and, geopolitical event to some extent too. So we'll talk about those results. But Danny, I don't know if you want to kick it off with a general overview or thoughts about what came from Jackson Hole on Friday night, because obviously the market's more or less welcome to what was communicated.
Yeah, indeed. I think the overall take, I mean, it's interesting to read the whole of his speech because there is a lot of information in there. But the key takeaways are a dovish messaging, and I think some of the key phrases were that downside risk to employment are rising, and that policy with the policy at where it is now, which is in restrictive territory, the baseline outlook is shifting the balance of risk may warrant adjusting our policy stance. So essentially, markets read that as we are focusing on employment. Employment has got to the point now where it's softened enough for us to be confident to be able to cut rates, given we still remain in a pretty restrictive stance. So markets are now pricing in around 85% chance of a rate cut in September. I think it went up from 65 to 85 just after the speech. So clearly markets taking this as a pretty dovish view from the central bank, and that ignited a rally both for stocks and bonds. We saw yields dropping. We saw the dollar dropping as well on the back of it. The dollar has kind of shifted now from a shift away from US exceptionalism, which was weighing on the dollar. We've kind of got over that, which warranted the recovery rally that we've seen in the dollar in the last few weeks. And now the dollar has, again, some downside pressure on the fact that the Fed is now ready to cut rates, which of course weighs on the currency. So that is kind of the key takeaways. When it comes to tariffs, there was a question about tariffs and about higher inflation. And Powell said that the reasonable base case was for a relatively short-lived impact of inflation. So a very short-lived effect, a one-time shift in price level. So again, kind of advocating that rate cut because tariffs are no longer a significant threat for long-term inflation. If anything, they will cause a short-term once-off change to prices. And I think that's, again, opening the door to those rate cuts. Now, the one thing that I will say is this is Powell's speech, but essentially he's talking for the whole of the FOMC. Now, the question arises, does he have enough support for what he's talked about? Does he have enough support for cutting rates in September? Essentially, you would think September, yes, but what about from here on out? The FOMC meetings from June suggested that the members are 50-50 on whether to start easing again or not. Will he have any pushback? Should he have been maybe a bit more hawkish with his messaging and maybe not given away so much? And that may cause some kind of imbalance in the yield curve process. So we've seen the dovish view pushing short-term rates down, but long-term rates may rise if inflation expectations go up and people start to lose confidence in the Fed's ability to suppress it. So yeah, Kyle, there was a lot from that speech, a lot to take away, but I think if we're looking at markets specifically, pretty positive for risk appetite, dovish view. They're going to cut in September. It seems pretty much a given at this point. And that weighed on yields and the dollar, pushed bonds and stocks higher.
Yeah, and I think the price action was really interesting. Just as we take a look at the S&P 500 at the moment, we'll take a look at the Nasdaq shortly too, which, as we can sort of see here, futures are dipping very slightly, but we are coming off a fairly significant rally on Friday night. Was that, it was very much a kind of circular ride in the markets from the start of the week last week to the end of it, which is to say, like you said before, we have got around about an 85% implied probability, give or take a couple of points either side, depending on when you look at the FedWatch monitor tool, baked in for September, say 1 in 3 chance that we'll get 3 cuts before the end of the year. But that sort of diminished going into the particular speech that Powell delivered on Friday night. And it diminished from a point of, pretty much an 85% probability this time last week, when we were talking last, of a September rate cut, which is to say that markets got a little bit concerned that maybe, there was a risk that Powell would be a little bit more hawkish than expected. And as a result, wouldn't come out with sort of a, kind of dovish tone and guidance towards a September rate cut. Lo and behold, he did. So, if you look at market pricing, rates markets are, ended up back to where they were at the start of the week. And as you can see here with the S&P 500, you can see that more or less the equity market ended basically where it started the week as well, which is, just below record highs. And the Nasdaq is in a slightly different situation. It has to be said, still, a couple of percent off those all-time highs. But of course, this is also a part of that story of a rotation that's going on at the moment, which pushed the Dow through previous resistance and to a record high as well, which in fact, outside of Wall Street, we sort of talk about some other major indices across the world in terms of, European stocks. Of course, in Australia, we had the same dynamic as well. Record highs for some of those indices that are a little bit more cyclical in nature, those that, might be a little bit more heavily weighted to, say, financials or consumer discretionary, certainly not the tech stocks seen on Wall Street. But nevertheless, we're sort of back on an even keel now, looking for that next impetus to drive the market higher. And I guess from here, it's really about the data that we do receive to sort of vindicate the Fed's guidance or Powell's guidance that we saw at Jackson Hole. One of those things will be non-farms, which comes in a couple of weeks' time. It won't be this Friday; it'll be the Friday afterwards. But then it's this PCE data coming out on Friday night, which, Danny, maybe you can chat about now, is expected to show a bit of a modest uplift in inflation to about, I think, 2.9%. But nothing that, the Fed hasn't already flagged that it's sort of willing to tolerate, like you said, in the short term because of these one-off changes in the price level, and, is still willing to cut interest rates. I suppose the question is, if it comes with a 3 in front of it or not, that might be the big scary outcome. But we're expecting an uplift, and I think the markets are still expecting rate cuts, even if we do get that 2.9% number.
Yeah, it's interesting though, because we came from, I think it was what must have been like 10 days ago now, before that PPI reading, which was not last Thursday, the one before, markets were actually leaning somewhat towards a 50 basis point, that jumbo cut, which is quite odd to see, and it only comes in times of real concern from central banks. So it doesn't send you a great messaging, and I don't think the Fed would have gone for it. But markets were still kind of pricing that in to some extent. If we're looking at the current pricing, we're seeing that 85% chance of a cut in September, 25 basis points. The remaining 15% are geared towards a no cut. So it's interesting to see that markets haven't shifted once again back to that 50. I think realistically, market participants knew that the likelihood of that happening was very, very low. And of course, as we've said, we still have the PPI data, for example, that came in much higher than expected, which suggested that, if producers are seeing higher inflation, that could be brought out through the production line towards consumers in the near future, and therefore continue to have persistent higher consumer prices as well. So I think it's just an interesting remark there that, markets have stayed pretty stable with, okay, when we're pretty confident that the Federal Reserve is going to cut rates next month, but we're no longer leaning towards a 50 jumbo cut, because realistically it's very unlikely. And yeah, I think as you can see there on the chart now, that 87% chance leaning towards that 25 basis point cut, the remainder just staying unchanged.
Yeah, and just always, oh, actually, sorry, I think I've got myself, sorry, taking myself off mute. I always like to have a look at just sort of what's priced in before the end of the year, as we noted before as well. And you can kind of see that there's that flirtation with the idea that there could be cuts coming at the October and December meeting too, say 25 basis points here at both potentially. The markets are basically, fully pricing that there'll be, another 25 after September too. But that's kind of the lay of the land. And I think, if we come back to that sort of inflation data that we've got at the end of the week, the forecast for the core PCE is, that 2.9% figure, which, does suggest that there are upside risks to inflation. Obviously Powell was, careful to mention that is the Fed's obviously cognizant that they don't want this sort of one-off lift in price pressures or in inflation or the price level to turn into something that's a little bit more inflationary because, say, expectations become a little bit unmoored. But in saying that, I always like to kind of look at these things in the context of what has been laid out before us in the past through the Fed's summary of economic projections, so its forecasts and where it sees the kind of glide path for inflation going forward and how that might affect interest rates. And if you do look at that kind of most recent summary of economic projections, the Fed actually forecast core PCE to rise to about 3.1% by the end of 2025, which is effectively to say that they're kind of willing to tolerate inflation on a core basis, on a core PCE level, up to about 3.1%. And still cut interest rates, because if we looked at those previous summary, the previous SEP, yes, it's not a forecasting tool. It's just to give a little bit of an estimate as to where members see interest rates going forward. But if you consider that the median dot at that last SEP was implying 2 more rate cuts before the end of the year, and that the average forecast for inflation across the board was about 3.1%. It shows that, again, there's that tolerance for a little bit of upside in inflation, and interest rates. The Fed still thinks it can and will cut interest rates through that process, especially now that we're starting to see this sort of softness in the labor market, which could, even possibly push the unemployment rate beyond what the SEP was forecasting for joblessness going into the end of the year. So effectively, I think, the markets now are just kind of looking at that dynamic to come to fruition to ensure that everything kind of remains on an even keel. And if that happens to be the case, then certainly we're starting to see those downside risks emerging to economic activity. Although it has to be said, as a bit of an aside, we did have the flash PMI surveys last week, which were actually really quite solid, showed a bit of a pickup in employment in both the services and manufacturing sector, albeit, there is still that concern of price pressures, building and being revealed in that data as well. But nevertheless, I think there is this kind of sense in the markets that provided the Fed does cut interest rates, that they'll be able to sort of remain ahead of the curve enough to support the economy. And of course, there's the kind of the valuation benefits that come through from that as well, from just, lower rates. And, that's also a part of this kind of rotation trade that we're seeing from tech to cyclicals as well. But Danny, another one that I've kind of been looking at, just because it moved a lot on Friday night, but it's still tightened like a little bit of a coil. And we talk about it every week, so we may as well preempt any kind of question about it because it's an important market, is gold. For me, still looking quite constructive in the bigger picture, but still in this kind of consolidation pattern and waiting for maybe something more significant to either break out to the upside and continue this upward trend, or potentially to break to the downside and obviously indicate that maybe there's some further weakness coming through for the gold price.
Yeah, I think, look, we talk about it every week, and I think with gold is fundamentally, as we say, long-term support remains strong. There isn't really a reason to be a seller in the long term if you look at all these fundamental drivers that are coming through. But it is starting to look a little bit overcrowded, and I think we're seeing a lot of we're seeing these one-off daily performances that are backed by some sort of announcement or data point, like we saw on Friday, that dovish view driving gold higher. But there really is a struggle to continue to follow that trend. And as soon as we see one positive session, we then see a few of kind of rebalancing and resetting where we were. So clearly there is a lack of fundamental drivers in the short term. Again, it goes back to the fact that we're seeing the data and the outlooks for specifically the US, and they are slightly confusing and they lack some sort of direction because we're getting a lot of mixed pictures, even though the overall trend seems to be positive. And we're seeing to some extent some data coming in strong and showing a resilient economy. On the other hand, we are seeing softening areas, like for example the labor market in the last few readings, and this has created some kind of uncertainty where traders and investors don't really know they should be seeking protection or coverage in their portfolios with safe assets like gold, or whether they should be still heavily invested in the equity market, which continues to drive higher even as the picture is softening. So I think this uncertainty is what's kind of keeping gold kind of range bound. It's not uncertainty with regards to are we seeing a recession or are things going to worsen. It's more of an uncertainty of is there more positivity, or is there more appetite to drive higher in risk assets? And that's why it's keeping gold very much leveled here and range bound. So it is kind of hard to predict where it's going to go because we have seen a few positive catalysts for gold, but they've struggled to break that 3,400 level, still remaining as that short-term resistance. It's clearly going to take quite a bit to break through, and at this point, I guess maybe the September rate cut may be the most obvious catalyst for gold to break higher. We may see something before then. We may see, I don't know, the PCE data coming in much softer than expected, or something along the line if we see the labor market report that we get before that Fed meeting showing once again a worsening labor market, maybe more than predicted, then we could see that drive coming through. But it is kind of a struggle at this point to find the reason to break higher in the short term, even though we still think that gold is a really good investment for longer term portfolio diversification. So yeah, it's going to be interesting to see what is the next thing that's going to break and how are we going to break above that 3,400 level.
Yeah, and I suppose you just really want to see that kind of break and then consolidation for a little while to kind of confirm
Yeah.
that, the markets are starting to renew that uptrend. But again, without a catalyst, perhaps, we might be left wanting for a little while longer. But, maybe because we didn't look at the charts before as well, we can just sort of take a little bit of a look at maybe just the Euro USD to begin with, in the context that most of that, a lot of that story anyway, is very much driven by the trend in the US dollar. And there is what I think is an interesting kind of dynamic emerging where we might be seeing a sort of renewed uptrend in the euro now that the markets are once again sort of a net seller perhaps of the US dollar after the Jackson Hole speech. And I just sort of note that there is this possible emerging breakout of a downward sloping trend line here, short-term trend line. But I think it also maybe dovetails a little bit to something that you wrote in our weekly email, or something you referenced in our weekly email this week, Danny, which is there's also some German data coming out, which also may be significant in driving the next move in the euro. And, obviously as an extension to the broader currency complex, because if the euro does have some domestic factor to strengthen, it does weaken the US dollar, there is that flow-on effect to other G10 currency pairs, or, currency pairs more broadly.
Yeah, well, we've had the German IFO data come out already, actually about 20 minutes ago. Bit of a mixed picture there. The business expectations were actually stronger than expected, just above that 90 mark, 91.6, with the IFO business climate also coming in higher than expected. However, current assessment was a little softer than markets predicting. So again, that mixed picture, and this goes back to at which point are we? Where are our expectations with regards to what's the future of the economy? What do we expect in the next 6, 12, 18 months? How are businesses going to progress? And we're seeing with a lot of these sentiment data prints that we do have a bit of a mixed picture. They are improving, coming from a point maybe 6 months ago where we were all concerned about a deep recession, especially on the back of those US tariffs. We're now at a point where everyone seems to be a little bit more optimistic about the outlook, but there really isn't a outstandingly positive outlook, if you know what I mean. So again, we've come from a period in the last 2 years of such resilience and strength on the back of that COVID era that markets have kind of now gotten used to it, everything being so positive and earnings being so good and the outlook for the economy being so good. So now, again, we've improved slightly from what tariffs were, but the outlook still remains slightly uncertain. And we'll have some CPI readings as well this week in the Eurozone, I think towards the end of the week on Friday. And they're only going to be regional readings. We get the Eurozone CPI next week. But again, it could mean a little bit of momentum for the Euro. If we see some of those regional readings in Germany, in France, in Spain come in slightly higher than expected, we may see the Euro inch higher a little bit, because remember, we are at a point where the ECB has lowered rates significantly. They now remain close to their neutral zone, and they've already hinted in the past that they're not planning on cutting further unless something significant happens. So on the base case for that, with no future rate cuts expected, if CPI does remain resilient, then we could see the euro driven higher just a little bit on the pace of those rate differentials. Of course, we don't want CPI to get ahead of where the central bank expects it, because that would have to warrant potentially rate hikes in the future if we were to see a period of stagflation. But I think as long as, you know, the CPI shows that the economy remains resilient at a time where rates have already been lowered significantly, I think the euro could see some positive drive on the back of that.
Yeah, I'm still kind of just bearish on the US dollar overall, that, you know, we are seeing something of a sustained downtrend still. And that the move that we saw recently was a little bit more of a counter trend more than anything else. And that, you know, effectively we will start to see the euro pick up over time as well. And while some of these key levels you can kind of spot, I think, fairly clearly, and not only that too, this kind of broadening out pattern, which, you know, typically shows a degree of uncertainty, but generally happens to be a continuation pattern when you look at it from a technical standpoint. The euro is looking poised, in my opinion, or has the basis to move higher. Obviously, the levels that you might want to keep an eye out for is just this downward sloping trend line, which if broken starts to suggest that maybe we're seeing a breakout. And the very key level, just to confirm whether we are getting a continuation of this uptrend, is that sort of 118 mark, which we saw something of a double top over the last few months between July and August. Very sort of significant level of resistance in the short term there. Obviously, there's some downside levels there too at 116 and 114, just to keep an eye out for, which, you know, if we do see that sort of downside break, might start to paint a picture of a bearish market for the euro, and we might start to reconsider our stance there. But I might take a very quick look too, just on the currency theme, just to the Japanese yen, because it's one that I've been fairly, well, USD JPY sort of fairly bearish on up until, well, all year, more or less. And I still sort of consider the move that we're seeing recently as a bit of a counter trend. But one thing that has been happening in particular is a really strong defense of 147 as a key level to watch. And one thing that's happening in the Japanese economy at the moment that we sort of had fleshed out a little bit on Friday morning, we get some data out on Friday this week, which is the Tokyo core CPI. We had the national core CPI, I think it was last week. Tokyo core CPI this week is showing that inflation is accelerating again in Japan, accelerating at a pace that is a little bit quicker than expected. And in principle, I think that should mean that eventually we will get a more hawkish Bank of Japan. There's also these fears around sort of, you know, fiscal policy in Japan, and that we might start to see looser fiscal policy going forward because of the sort of LDP's sort of relatively tenuous grip on power after the most recent elections. But what I will note is that if we zoom out very quickly, actually, just, you know, as the old saying goes, when in doubt, zoom out. I still think you can make an argument that this trend for the yen is to the downside, with obviously 140 being a very critical level to watch. You can see there a series of lower highs being marked on the charts. In the short term, we are struggling to see a push in the yen below 147, which sort of represents a pretty critical level to watch. We've also got maybe in the short term a little bit of a range that we've been carving out here at 148.50 being sort of the top of that sort of very short term trading range. But again, it's another one that's very dependent on what happens with the US dollar. If, for example, we get the markets edging ever closer towards pricing in those rate cuts and more rate cuts towards the back end of the year, market sentiment remains reasonably robust. And as I suspect, the Bank of Japan will eventually have to, you know, bring out the hawkish plumage to deal with this kind of pickup in inflation, the yen should continue that primary downtrend. However, in the short term, still waiting for those signals. So just want to watch there potentially. Danny, before we take questions, should we take a very quick riff on just NVIDIA's results? I'm happy to run through that too, just because it's obviously
Yeah. Yeah, I was going to say, with NVIDIA being one of the key events for this week, it would be interesting to go through. Just from my point of view, I know you've got more of the nitty gritty of the what's expected, but I do think it is, as the largest stock in the stock market, I think it is going to be a key barometer of appetite in the market. And NVIDIA's results do kind of sway the momentum as well, not only in its own stock, but also in the general market. Expected to be pretty good from what I've read. And of course, a lot of that depends on AI and the future of AI and some of these chips. I know they've had issues with China, which maybe you can go through in just a second. But one thing maybe to note is, could we potentially be at a point where markets have gotten so used to seeing positive results from these kind of huge companies that drive the market? Could we potentially be in for some disappointment, maybe on the outlook? Maybe the quarter hasn't been as good as expected. Is it going to be good enough to impress investors, specifically to see that positive reaction in the market?
Yeah, the bar's obviously set really high, and you can kind of see that the stock's now having a lot of trouble breaking through 185 or thereabouts without sort of fresh news. And you can make an argument that we've seen a bit of a breaking of an uptrend, the short-term uptrend here from the April lows over the last couple of weeks, which might be a little bit of a bearish signal. But when it comes to these results in particular, there's a few things to keep an eye out for. When it just comes to the fundamentals, effectively, the company is forecasting 50% earnings growth, 50% top line growth, 50% net income growth for this particular quarter. But obviously, what's going to be really critical is the guidance in particular, and the numbers there escape me. I was writing an article about it today, so I apologize. I won't be able to provide that off the top of my head. But obviously, there's the element of wanting to see that there is still a very strong growth outlook for the company, which sort of relies on the business noting continued investment from hyperscalers, but not even just hyperscalers now, but sovereign investment projects, so from governments, but also major investments in sort of tier two cloud companies. So effectively, not those hyperscalers, but still companies that are trying to build cloud infrastructure or are exposed to cloud infrastructure, which are trying to integrate artificial intelligence into their product lines. So those are going to be the sort of core fundamental drivers. I think it's the G200 and the G300 chip are basically crucial to that endeavor. And the market's going to be looking at the production of those chips as well as the future orders for those chips to get a little bit of a sense to what extent all of that can be monetized at a growth rate that the markets are expecting. The other two elements to consider here is obviously, those are the first two elements, which is really the company's growth and sort of the AI spend, which is all about whether there is, a degree of overinvestment going on or not. And, we have seen maybe a little bit of a drop off in tech stocks over the last few weeks because of, again, those renewed fears that maybe cash flows are being sort of directed towards a level of investment that can't be sustained in the long run. There was that MIT paper that came out last week that sort of suggested that 95% of executives in the United States don't see yet a monetizable use case for artificial intelligence. So everyone got a little bit skittish again about sort of what degree of overinvestment is going on. So that's going to be also really relevant for the story too, because obviously NVIDIA sits at the nexus of all of this when it comes to the chips required for these hyperscalers to continue to invest and what have you. The final thing will be geopolitics, which will be really interesting because obviously business in China has been severely disrupted over the last couple of quarters because of chip curbs from the United States. But then, those curbs have gotten lifted more or less. But the Chinese have now instructed a lot of their corporates not to use NVIDIA's H20 chip, basically on national security grounds, which throws further doubt to what extent the business will be able to sort of scale up and expand its market share in China, especially at a time where there's a lot of Chinese competitors sort of emerging and being supported, obviously, by the central government because chip security and technology security is such a crucial part of this kind of Cold War of sorts between the US and China. The other fascinating point too is obviously NVIDIA's pledged to give 15% of its revenues, not just profits, but 15% of its revenues generated in China to the US government, more or less to maintain sort of favorable regulatory conditions with the White House, with the United States government. So that's also going to be something that's going to play into that overall story as well. So it's going to be a really, really complex one. And, I was sort of saying it today that NVIDIA's results kind of transcend the company itself now and start to go into the realms of artificial intelligence, the macroeconomic outlook, and the geopolitical backdrop. But if we kind of zoom out and we sort of talk about, like you said before, Danny, that we've got, I think it's the trailing price to earnings at around 40 to 1. Sorry, no, that's the forward price to earnings, actually. I think it's around 40 to 1. We've got the price to sales, and that's on a trailing basis around about 30 to 1. These are fairly consistent, not quite at the levels, but fairly consistent with the levels that we've seen corrections in the past. And so it just begs the question to what extent the company can kind of justify these multiples at the moment. And the technicals may feed into that to some extent because we have obviously seen this failure to break to new highs through 184, this pullback in obviously the RSI, which suggests sort of downward momentum, and this upward sloping trend line breaking. Obviously, if you zoom out, and there's this really great trend line that I just want to point out before, obviously we move on to maybe some questions or some different things. There's basically a really significant trend line that you can kind of get a sense of, maybe not very well on this particular chart, from around about here to around about thereabouts. And this isn't particularly relevant unless you're sort of looking to really dabble in the stock in the long term. But we're still looking at a company that's in a very solid primary uptrend. However, one would assume, based on the price action that we've seen here, that maybe we're reaching a little bit of an exhaustion point. We've got the RSI at an overbought level, but turning lower. All these kind of indications that maybe we're at a bit of an exhaustion point. So keep an eye out for that on Wednesday night, your time, Danny. Thursday morning in our time, because we always wake up to it after the closing bell. Could be one that really rocks the share market if there is a miss, because the company is in the position that a downside surprise might be punished, and there is a lot of risks sort of being played into there, a lot of variables, which could be that thing that kind of just gives a little puncture of NVIDIA's stock, given the run up we've seen over the last few months.
Yeah, it is. It will report after the close on Wednesday. So for any of you people trying to trade that, it may be an interesting setup to do it on Wednesday before the market close. Of course, you have a post and pre market trading, but realistically, the big reaction you're going to see at the open on Thursday. So in order to take advantage to any moves, setting up on Wednesday may be an interesting play. Kyle, we have run over time. Just quickly, we do have a question on specifically the stock market and what are some good cyclicals to rotate into. It's hard to say individual stocks, but if you're looking at sectors, one that's quite interesting is I think the home builder sector, because if you're considering that mortgage rates are expected to come down in the US with rates in the next 12 months or so. And we do still have a high degree of optimism in the market and about the economy, then home builder are likely expected to go up on the back of that. So maybe that may be a good option for the future. And I also read recently from one of the big investment banks, I can't remember who it was exactly, something about the healthcare sector being undervalued, how there was a lot of good investment coming into the market with new machinery, new techniques, and how it was undervalued and underinvested. So maybe, the healthcare sector is a good one too, if you're trying to kind of get out of some of those very overcrowded areas like the tech and semiconductor areas.
Yeah, absolutely. I think, the only thing that I could add is that in Australia over the last week, we have seen the miners do reasonably well. So, there's commodity names that, might benefit from a bit of a pickup in economic activity as well as a weaker US dollar. That's been one that has done well over this part of the world in the last, maybe call it a week and a bit. But yes, we've run 4 minutes over time, so we may as well wrap it up there for another day. Thanks everyone for joining. Obviously, wonderful to always have your company. Please provide any feedback. We do upload this on our YouTube channel after every episode. So if you would like to watch it back or share it around, ideally as well, because clearly we want to get our views out there as much as possible and spread the good word. But Danny, otherwise, do you have anything to add before we shoot off for another week?
No, that's it. Thank you so much, everyone, for joining. We'll be back again next time here next Wednesday. And as you said, it's live. It'll be posted to YouTube in the next hour or so. So if you need to watch back or share it around, then we really appreciate it.
Wonderful. Have a great week.
Thank you.